Hey everyone, welcome back to Resonance Spotlight Strategy Notes with Vincent and Saâd. So today we are talking about something that doesn't usually make headlines in the multi-manager world, but it's really fundamental to how these platforms work. We are talking about the center book.
Yes, and I think this is the thing, right? Everyone gets excited about the pods, the PMs, the alpha generation, and the center book is, well, it's the infrastructure. It's what makes all of that possible.
Exactly. It's not the sexy part, but it's essential. And honestly, I think many allocators don't spend enough time understanding it when they do their diligence.
I agree, so let's break it down.
All right. So, first question, what is a center book? Because I think the name itself can be a bit misleading.
Yes, exactly. So the center book, sometimes people call it the core book or the house book. It's basically the pool of capital that's managed centrally by the firm, not by the individual pods. So while each PM is running their own book within a tight risk budget, the center book sits above all of that. It manages firm-wide exposures, the balance sheets, liquidity, all the things that keep the whole operation running smoothly.
Right. And it's not one strategy, it's really a set of mechanisms. If the pods are the engines, the center book is the gearbox. It doesn't create the power, but it makes sure this power gets delivered efficiently.
I like this analogy. So why does it exist? What's the actual purpose?
Well, there are several reasons, and it depends on the platform. But the main one is risk management. When you aggregate all the positions across dozens of pods, you will have exposures you didn't intend. Maybe you are unintentionally long momentum or short value. Maybe you have a regional tilt you don't want. So the center book neutralizes that.
So it's like an internal hedge fund for the hedge fund.
Exactly. And the second main reason is liquidity and financing. The center book manages cash, collateral, margin. It's a firm's treasury, making sure capital is in the right place at the right time.
And then there's the efficiency part, right? Like if one pod is long Tesla and another is short Tesla, you don't want to finance both sides of that trade externally. The center book nets it internally.
Yes, exactly. Reduces cost, reduces noise, and then at some firms, not all of them, the center book is more ambitious. It's not just defensive. The CIO might use it to express house views or take systematic overlays to actually add return.
Okay, so there's a spectrum here. Some center books are purely defensive and others are more active.
Right. So you have a few types. There are risk overlay books, focus on stability, hedging, balance. There are liquidity or treasury books, managing the balance sheet, repo lines, idle cash. And then there are active or strategic books where the firm is taking a discretionary or systematic positions on top of the pod's exposures.
You got it. So who runs this?
Usually the CIO or a central risk team. And again, the mandate varies. At more conservative platforms, it's defensive, exposure management, liquidity. At others, it's an extension of the investment engine. The CIO can express view or scale top ideas.
And what's the toolkit like? What instruments are they actually using?
It's a wide range. On the simple end, you have a listed instrument, index futures, sector ETF, government bond futures, then OTC instruments, swap, options, FX forwards for hedging or currency overlays, and increasingly you see structured trades, basket, delta neutral factor hedge, and QIS, quantitative investment strategies. Things like systematic overlay, factor replication, carry harvesting.
Yes, and the modern center books are running on real-time risk systems, right? So as the pods move, the center book adjusts.
That's the ideal, yes. But this brings us to what allocators should actually be looking for when they do their diligence. Because it's easy to be impressed by the jargon, systematic overlay, cross-pod optimizations, these kinds of terms, but what matters is whether they can actually measure and manage what they're doing.
Okay, so what should you be asking?
First, risk measurement and transparency. What types of risk are being measured at Hedge? Is it market beta, style factor, tail risk? As a hedge linear or option based? And this is critical. How timely is the data? If risk reports come T minus one, but the book trades intraday, that's a red flag.
And what about external managers or sub-advisory pods? Those exposures integrated.
Exactly. That's a very good question to ask. Second thing, implementation quality. Even the best ideas lose their edge if they're implemented late or poorly. So ask about execution lag. How quickly can the center book react when exposures change? And how are trading costs and liquidity impacts allocated between pods and the center book?
Yes, because if the center book is slow or expensive, it's not adding value. It's actually dragging performance.
Right. And third point, value attribution. By design, hedging reduces return, at least initially. So how does the manager measure whether the center book is adding value? You need a framework that isolates its contribution on a risk-adjusted basis, not just raw P&L.
And then there's governance and incentives, which I think is really underrated.
Yeah, that's huge. If the center book is active and aiming to generate alpha, who decides what goes in? Do the underlying PMs benefit if their ideas are scaled in the central book? Or is it just a way for the firm to cheaply leverage best ideas without compensating the originators? Because if it's the latter, you have a sustainability problem. It's a cultural issue, not a capital issue.
Yes, this is where you see things break down over time. The PMs stop sharing their best ideas because they don't see any upside.
Right. So when you're evaluating a platform, the center book really deserves attention. It's not just the plumbing, it's philosophy. It's where portfolio construction meets the CIO's vision.
And when it's done right, it turns a collection of independent pods into a coordinated platform.
Yes, if the fund is an orchestra, the pods are the soloist. The center book is a conductor, unseen by the audience, but absolutely essential to the harmony.
All right, so if there's one thing allocators should take away from this, it's don't skip the center book in your diligence.
Right. Ask the tough question. How are you measuring risk? How quickly can you react? How do you attribute value? And what are the incentives?
Because what you can measure, you can manage.
Exactly. All right, that's it for today. Thanks for listening to Resonance Spotlight Strategy Notes.
If you found this useful, share it with someone who's evaluating multi manager platforms. And we'll see you next time.
See you next time.